Thanks a lot for coming to the session on reducing debt. So it's session 2B. So it's session 2B on reducing debt. If you're looking for another session in the other room on the second floor, but you're probably in the right session because it's several fascinating papers. The rules are that so at the order of the session, we have 15 minutes per presentation. I won't say more because I think the real important thing is other speakers. So go away.
Okay, so there is a default here. So Andy Powell was supposed to present it, but it couldn't come, so you got me. And how is there a way to control this? I don't. Okay. Anyway, so you got me and not Andy. So this is a presentation. It's more of a policy paper. So there is no hardcore econometrics. And I did a presentation. It only has pictures. No. In fact, there is an equation. And so there is a default. Andy is not here, but you're getting something more because on the program it's just said debt reductions. You're also going to get debt explosions. So let me start by using a sport analogy. So think about cycling. So this is the guy who just won the Giro d'Italia. In cycling, what it matters for success is mostly how hard you can pedal. The bicycle matters, but it's not that anybody wins if that's, they're more or less all the same. If you think about another sport, the next one, it's motorcycle racing, or you can think Formula One if you like more Formula One. So this is Pecco Bagnaia and this Marc Marquez. So Marc Marquez is one of the best riders in history, but for a few years it sucked. He didn't win anything because he didn't have a good motorcycle. So there you need to be a very good rider, but also you need a very good motorcycle. If not, you're not going to win. And so my story is a little bit like this, that when you think about what happens to your debt, fiscal policy, which was I call being a good rider, matters. It matters a lot, but it's not enough. So let's go ahead. So this paper is about, we looked at what countries do when their debt explodes, and then define that explosions, or when their debt contracts, shrinks very rapidly, and I'll define this in a moment. And to look at these debt explosions and debt contractions, we focus on 5-year periods. We just didn't want to look year-on-year things. And so this is basically the average change in debt in all emerging market countries over, so these are 156 countries between 1980 and 2020. And so you see that over the average 5-year period, that goes up by about 2 percentage points of GDP, which is weird because if you think that debt is used as a counter-cyclical instrument, it should sometimes go up and sometimes go down, so on average it would be 0. But that's not the case. So that's for all emerging and developing countries. Latin America and the Caribbean, much more. Oh, happy here. Thank you. So Latin America and the Caribbean, much more. East Asia and Pacific, actually, it's 0, like you would expect if that is used in a counter-cyclical way, and so on and so on. Now, if you take the Economics 101 class and you learn on what drives the debt to GDP ratio, you probably learn that, there is something that increases the debt to GDP ratios. If you have primary deficit, if you spend more for current expenditure than you get in taxes. And then, the other thing that drives the debt to GDP ratio are interest payment. And then since debt to GDP ratio is the debt over the GDP, and we measure this in nominal term, if you have either high inflation or high growth, that tends to go down. And this graph shows for all the countries how this factor contribute to the change in the debt to GDP ratio. Whatever is above 0 are factors that increase the debt to GDP ratio. But the primary deficit a little bit, not so important. Interest payment, important. Then there are factors that contribute to a decrease in the debt to GDP ratio, inflation, and real growth. But then there is this purple stuff, which is the stock flow reconciliation, is what we call at some point the unexplained part of public debt. And when you look at this graph in every country, whatever, this unexplained part of public debt seems to be very important. So I'm going to call this, to go back to Marc Marquez. The blue part is Marc Marquez, and the purple part, the motorcycles. Whether you get a Ducati that goes very well, or you get a Honda that right now sucks. This will go down. It sucks. Okay. So what is this Ducati and what is this Honda? Before getting there, let me just tell you, so this is just, as I told you before, this paper is of debt explosions and debt contraction, and we define this. We basically plotted the distribution of debt changes over a 5-year period for all the countries that we have, and we just pick 4 arbitrary thresholds to define debt explosions and debt contraction. So this is the 10% of the 10th percentile of the distribution. So we call all what is here as a large debt contraction. This is the 20th percentile of the distribution. These are what we call 20% debt contract, 20 percentile debt contraction. So our debt contractions are changes in debt which are here. And the debt explosions, the very large, are in the top 10 percentile, and the kind of largest are in the top 20 percentile. So these are our debt explosions, and these are debt contractions, whatever is in the middle of the drawing. So when we look, so by constructions, 10% of episodes are P10 debt contraction, and 10% are P90 debt explosion, and 20% are P20 debt. So if you look at the distribution, whichever region here is above 10% is overrepresented, and here is about 20% is overrepresented, and when it's below 10% or 20% underrepresented. So what you see here, you see that sub-Saharan Africa is overrepresented both in debt explosions, in debt contractions at the 10 percentile. And when you look at debt explosions, the countries which are overrepresented are Middle East, Latin America, and Sub-Saharan Africa. So it's interesting, you see state is underrepresented in both, because you can think if your debt doesn't go up, you don't need policy to push it down dramatically, right? So you're always in kind of in this intermediate range. So what do we do next? Again, there is some econometrics in the paper, but I didn't put anything here. What do we do next? We look at what are the drivers of debt reductions and that explosion. I think I'm going fast with doing well with that, right?
6 minutes.
6 minutes. Okay, good. I use 6 minutes, right?
Use 6 minutes. Yeah.
Oh, I'm gonna finish early. So I can even take questions. So we did a decomposition similar to the one I showed you before, and we looked at what are the drivers of debt reductions. And a little bit in the way that I showed you when I had this graph, and this graph I didn't focus on extreme events, I just focused on all the distribution. Also, when we look at extreme events, inflation is the main drivers of debt reduction. 60% of debt reductions are associated with inflation. Now you tell me that this number, these numbers add to more than 100%, and the reason is why some debt reductions or debt explosion are co-caused by 2 factors, so we kind of put them together. So inflation is the biggest driver of debt reductions. Sometimes when you have high inflation, you end up having a negative ex-post real interest rate. So a negative ex-post real interest rate is another big driver of debt reduction. And then you have growth. And then you have the primary balance. So it's important. So the fact that you are running primary surplus is an important driver of debt reductions, but it's not the most important drivers. And then you have the stock flow reconciliation. So now let me tell you a little bit about the stock flow reconciliation. So the stock flow reconciliation is important for debt reductions. You will see it's much more important for debt explosions. So the stock flow reconciliation, as I defined it before, is like, I call it the unexplained part of debt because it's something which is not in the standard debt dynamic equation. So it's something that happens to the stock of debt, which cannot be explained by the standard flow variable, which are the primary balance, the interest payment, the GDP growth, and all this sort of stuff. So what it can be? So in debt reduction, it's mostly debt restructuring. So a country reduces its debt, defaults, restructure its debt, call it whatever it wants. This doesn't show up in the growth rate, it doesn't show up in the primary balance, it doesn't show up. But then when I compare the debt at times T and the debt at times T minus 1, the debt has gone down because that's been restructured. So these are mostly debt restructure. It's the HIPIC initiative, it's whatever it reduces the stock of debt. So now if you want to think ideally how you would like to reduce your debt, you would like to reduce it in growth. That's the less painful thing. Probably the second less painful thing is primary balances. But most of the debt is reduced with other things. Now I'm going to show you the graph about debt explosion. So growth could contribute to debt explosion if you have a massive drop in real GDP. So that's not a very important thing. Well, inflation never matters because you would have to have a very large deflation for your debt to explode. So that sort of thing. Very large real interest rate sometimes matters. But the two very important drivers of debt explosions are, well, bad fiscal policy. So bad, it would be good. During COVID, that went up because there were very large fiscal deficits. You might think that it was the right thing to do. But anyway, so it's partly driven by fiscal policy, but it really drives the majority of debt explosions is the stock flow reconciliation. So when we are looking at debt reduction, what was the stock flow reconciliation? It was mostly debt restructuring. What drives most of the debt explosions are balance sheet effects associated with currency depreciation. Some people from Argentina here, so the best example is Argentina 2001, 2002. So if you look at the numbers of Argentina in 1999, so I always tell this story. So Italy didn't have all the parameters, all the criteria to join the euro, right? The debt levels were too high, the deficits was kind of too high, they cooked the book a little bit, and everybody lost 1 or 2 or 3 eyes, and Italy joined. But if you looked at the number of Argentina in 99, the debt to GDP ratio was 50%, deficit was low. If Argentina had been in the right neighborhood, it would have joined the euro. Without cooking the books. But 2 years after, the debt to GDP ratio went from 50-55% of GDP to 150% of GDP. It's not that Argentina ran primary balances or even overall balances of 50% of GDP a year. It's simply the fact that half of the Argentinian debt was in dollars, the exchange rate was 1-to-1, and then the exchange rate went 1-to-4. And that showed up in the debt rate. But so Argentina is an egregious example, but if you look at most debt explosion, they are mostly associated with these balance sheet effects associated. Okay, I'm going to shut down. Are mostly associated with balance sheet. There are also a few other things. Other things are, contingent liabilities come out from the state-owned enterprise, all this sort of stuff, but that's mostly it. So this is what I call the rider, Marquez, and it's what I call the motorcycle, having a Ducati vis-a-vis having a Honda. The point that you can have a very good driver, you can have Mark Marquez, but if you have a bad debt structure, you're gonna be in trouble. So I just want to finish use my last minute that this is not completely exogenous, because if you have a good driver, you're very likely to get a good motorcycle, right? So Mark Marquez was for a few years running a Honda and sucking, but eventually Ducati hired him, and now he's on the podium again. In a sense that if you have good policies, you might also end up having a good motorcycle, a good structure. But when we look in the cross section, I think you have to look and be careful looking at both of them. And I'm going to shut up here.
Thank you. So you're leaving 1 minute. So I'll ask one question.
Okay.
A priori, you could identify the effects of the exchange rate. We know what the exchange rate is. We can kind of follow, and the external debt, currency is a bit hard to know exactly which currency, but we can kind of know, and it's harder to know what's debt discovery. So have you tried to look at the what depreciation, appreciation role is in this stock flow adjustments?
Not in this paper, but in other papers we have done it, yes, and it's very important. And the fund, so the next fiscal monitor of the fund is going to be all on this, and they're going to have much debt. And so that's what Vitor Gaspar told me, and they're going to have much better data than me. But already their preliminary work, they said it's about 50 to 60% it's debt, and then the remaining 40% is everything else together.
Thanks a lot, Hugo. So now we can move back to the event, and so now it's changing. So how do we maybe the stock flow adjustment on the reduction side? How do we make it more efficient? So that's Anahí for the second presentation.
Can we do Q&A after?
We'll do it.
Awesome. Well, thank you very much for having us, Yasin, and it's a pleasure to be here. I'm going to be presenting the first part of this paper, which we actually co-authored among 4 of us. We have Simon presenting the second part, and we also have Daniel, who is our lawyer represented today in this room. And I'm going to be presenting about designing sovereign debt legislation. The legalistic questions we'll then ask Daniel to kind of answer for us kindly, because neither Simon nor I are lawyers. First, I'm going to start by talking a little bit about the context and the aim of the paper. Then we're going to start with a very basic comparison that sets the scene. We're going to very briefly talk about existing legislative proposals. We're going to try to keep it as short as possible, but we're very happy to answer more questions on this in the Q&A. And then Simon is going to be talking about the policy concerns and the main part of the paper, which are essentially the design choices. So what motivated this paper? So to start with, our kind of key observation and point of departure is the fact that since the global financial crisis of 2008, particularly emerging markets and developing economies are facing a very fragmented creditor universe. A lot of attention has been paid to China, but equally as important is increase in private bonded debt, as well as other forms of debt, such as, for instance, quasi-debt, repo contracts, swap contracts, government guarantees, etc. All of this is happening in the context of the absence of a sovereign debt restructuring mechanism, which essentially has, by implication, that a creditor does not lose the rights he or she has in the contract, as stipulated in the contract, until the point in time in which that creditor either makes an agreement or exchanges that contract for another one. This, of course, generates the problem that you might have minority creditors throwing sand into the wheels of an otherwise kind of good enough restructuring deal. And this is where collective action clauses come in. So I think there is a kind of fair level of consensus, both in the literature, but also in kind of recent practice, that demonstrates that collective action clauses are very efficient and very effective in tying minority kind of creditors which do not agree to a restructuring to kind of majority approved restructuring. Over 70% of the outstanding debt of sovereign Eurobonds now include the last version of collective action clauses, the so-called enhanced tax from 2014. Now, the limitation that we see with collective action clauses is nothing on kind of the clauses per se, but more the fact that they're not well suited for all sorts of debt instruments. We're thinking about syndicated loans, bilateral official loans, and or quasi debt. It is not only the case that they currently do not include collective action clauses, but it is very likely that they won't do that in the near future or ever. So that is what in a way sets the scene for our paper. We think that we need to find some way of tying minority creditors to kind of majority approved restructuring that emulate what collective action clauses do for the bonded debt universe. And this is particularly important, as I was saying before, for emerging markets and developing economies, because in contrast, for instance, OECD countries who have a large kind of part of their debt in kind of bonded Eurobond bonded debt, emerging markets and developing economies have a much more fragmented creditor universe. And in addition to that, it is not only a concern for the restructuring itself, but quantitative research also shows that having an unresolved restructuring with holdout creditors might also inhibit market access or might inhibit emerging markets from accessing markets more quickly. So this is the context in which we kind of dive into the topic of legislative proposals. It is also in a context in which, in the kind of public policy realm, there's a lot of attention on domestic legislative proposals in financial centers. And what we try to do in a way is to bridge the legal kind of conceptual debate with the policy debate. The main reason why I want to do this is because we think that so far, at least in the public policy debate, the legislative proposals or the laws that have or that are already in place are seen as kind of isolated packages, but that there's not so much kind of conversation around, in a way, kind of cross-fertilization. So thinking about the design choices of these different proposals and the extent to which they might actually be compatible. So that is the aim of that paper, and we think that in kind of in talking about these design choices, we might actually also contribute to breaking down the, to a certain extent, overly emphasized dichotomy between, on the one hand, contractual reforms and on the other hand, statutory proposals. I'll skip the part on the terminology. This is the first substantive part of the paper. And what we do here is something which most of you are very aware of already, which is essentially kind of point out that on the one hand, corporate insolvency and sovereign debt restructurings are very similar. So they have the same overarching policy challenge. They are both embedded in the same legal framework. And yet what you see in light red is radically different. So there is an absence of a restructuring, of a comprehensive restructuring regime, which I already emphasized before, and enforcing sovereign immunity, enforcing judgments, attachments is very, very hard. It's much harder for sovereigns than it is for corporate debt. And that sets the stage for the domestic legislation, which essentially what they try to do is they all try to do the same, although very differently, which is imposing majority approved restructurings on minority creditors. Now, there are kind of several laws which are already in place, the UK HIPIC initiative, the Belgian law, the French law, and there's some that are currently being discussed. There are currently initially 2 proposals in New York State. Now it is 1 proposal. There's also kind of several aspects that have been included in that kind of amalgam of a bill, champerty, and kind of the reduction of the statutory interest rates. We'll not talk about those in this presentation. What we'd like to stress before I pass on the floor to Simon is the fact that they differ on kind of important aspects. First, some of them apply to kind of all countries, other to a subset of countries that is specified either in the law itself or in an initiative that is kind of associated to the law. Then there's a distinction between the debt it applies to, whether they only apply to existing debt or also to future debt. And then finally, what, like, for the lack of a better word, we in this presentation have called the underlying principle, which is essentially if, for instance, it is the Belgian law, again, Daniel's not going to be happy with this characterization, but a version of champerty law, whereas, for instance, France, the UK, and the New York intercreditor will essentially try to enforce comparative treatments, and the New York model law is a comprehensive restructuring regime. I'll pass the floor to Simon.
Thank you. So what we'll try to do is sort of set out the broad strokes of what sort of policy concerns should you try to think about? And then on the next slide, I'll go through like the specific themes that are present in all the current bills and that you at least need to have some sort of approach to. But first off, like we have a set of ideas that I don't really think are that controversial, which is essentially that the underlying economic policy is to support some sort of equal treatment of creditors by implementing domestic sovereign debt restructuring laws. Sort of the same principle that you have in corporate restructurings. No one, or very few at least, tend to dispute that this is a good sort of starting point. But how do you make comparable treatment enforceable? We have a little bit that within creditor groups it's possible, but we really want to try to sort of discuss laws where you disincentivize holdout strategies across multiple creditor groups, not just within a Eurobond framework or bilateral Paris Club and so on. And before we go on, there are a couple of people, many people who sort of argue that they're skeptical about these sort of things. And the arguments tend to come in three waves. The first is that it's not really a problem. CACs have sort of solved it. We argue that that is partly true for the Eurobond universe, and at least up until the global financial crisis, this was not really an issue. But we now have such a varied universe of creditor groups, whether it's financial structure products or China or bilateral groups, trade creditors and so on, that the coordination within the creditor universe is not really 100%. Then we have the idea that this will end up costing the countries who want to borrow money in the form of higher interest rates. We've not really seen in the paper, we go through the evidence, there doesn't seem to be any quantitative evidence of this. In fact, there might be a little bit of the reverse in the sense that at least the UK has attracted issuers since they passed the HIPC law. And then finally, that it undermines the trust in the legal system of the financial centers, of which there is no evidence whatsoever, at least yet. So if you try to think about what should a legislative approach solve or think about, try to, and my co-authors might not be happy with this, but I try to put it into 3 bullets, which is essentially to enhance creditor coordination of all the different types, facilitate orderly restructurings, which are timely. You don't incentivize holdout strategy, moral hazard, or venue shopping or delays. So how do we do this? So far, there are sort of 2 approaches to the creditor universe. Either you try to target the holdout creditors, hedge funds, the Elliots of the world, or you try to do it as a broader initiative where you think about holdout strategies as a proxy for bad faith, but more importantly, you try to incentivize everyone to actually participate in the restructurings. And integrating the majority voting across all these groups is the primary task and the most difficult part of trying to make legislation. So what do you need to think about when you have a legislative approach? We have 8 sort of themes. The first is whether you want to target holdouts directly or not. So a few of them did, in Belgium, in France, they target specific investor groups. We sort of argue that a more comprehensive style is better because you don't end up having definitional problems. Then you need to think about majority vote versus international initiatives. So this is whether a majority vote binds other creditors or whether you want to structure it around specific groups. So think about it, whether you have the CACs majority bind or bilateral binding other parts of the creditor groups versus you make judgments unenforceable for a certain type of debt. For example, all countries covered under the HIPC initiative. Then one of the more important things is comparability of treatment and the debt perimeter. So comparability of treatment is essentially that you need to have some sort of way of comparing different claims that might not be the same. Bilateral creditors tend to hate haircuts on the principal, whereas private commercial creditors are probably happier with a higher NPV if it means that you can get if you can push out some cash flow. The debt perimeter as well. Some laws you can actually capture some of the debt that might not be included in a normal restructuring, whether that's trade exports or whether it's short-term T-bills. Need to have an approach that one encapsulates all these sort of things, but it's also ad hoc enough so that you are not bound when you try to do a restructuring by some sort of rigid law. Enforcement, jurisdiction versus contract law, I'll skip that pretty fast. Essentially, the safe harbor laws have all sort of an enforcement jurisdiction, and contract law is not really binding on whether, like, the idea is that the more countries that actually try to have these approaches, the better they become, and the fewer places there are to go. The important thing is not whether contract law is applicable. The important thing is the trade relationships and the financing flows. Attachment limitations. We can sort of group the last three in the sense that are the laws. Do we want to have a law that limits the ability to get a judgment, or is it the enforceability of the judgment that is actually in question? Here, need to think about both. Where do we come in on the comparability of treatment? We want to set up a formula or actually calculating so that we can compare across different types of instruments, or do you want to just limit the enforcement action of whatever assets are in the jurisdiction? You can do that. We suggest a standstill. We suggest a clawback so that there is some sort of clock on the negotiations. And then finally, we see something most favored creditor treatments versus forfeiture. Do you want to be able to take the money back, or do you want to be able to hand out more money? Which we've seen in a few of the latest restructurings. All right. No, that's fine. We try to go through all of them, and all the different laws that are currently in place come down on either side of these eight themes. What we try to do is to think about that you need to think about all of these to have sort of a law that doesn't contradict itself in places which you might not have.
You can think about these in a way as heuristic categories that help you think through the different legislative proposals currently on the table. Thank you.
Now we'll go. That's what you. So this is a paper co-authored with Juan, Hatchondo, Leonardo, Martinez, and Francisco Roch at the IMF. So we go from a law paper to a purely economics paper. Now reducing debt by payments.
So the paper is about showing CoCos. So what is CoCos? So CoCos is like payment suspension of a debt instrument, and it's similar to moratorium law. So if you're familiar with moratorium laws, it's very similar, but it's for the context of sovereigns. And so, for instance, if we have a debt that is due, the maturity is due, let's say 2030. But then if a debt is suspended for 1 year, then the maturity of the debt becomes 2031 with no effect on the debt present value. So the first session was amazing. So the first session was like and also they talked about like previous debt restructuring processes, debt buybacks. So some initiatives that were taken before, and also we've seen some examples of sovereign talks. So there are some. So far there has been a lot of like discussions on how to address these debt payment issues. And I was trying to motivate how we can sell this paper, and I found out that one of the policy recommendation to address debt problems is debt suspension. So, but so far, so first it says that like our paper eventually does exactly this thing. So what we do is that if it is difficult for someone to repay that, then postpone it until the time of ease. So that's what we are checking. So the paper is all about this. So postpone the payment suspension until the time of ease. And we also go on for the paper, check whether debt forgiveness is good. And then it's also part of the script. It says that if you waive it as an act of charity, it's better only if you do, and then we check, and that's what the paper is about, basically. So, but reading up, so far, there is no attention. But even though this is one of the oldest policy recommendation, so far there has been no attention to these policies. And we've seen some attention with the COVID-19 for the mortgage payments and for corporate debt, but so far nothing, almost nothing for the sovereign side. And why this is important? Because now we go through a world record of high debt levels, both private and public levels, and now navigating through such. I don't need to go through this because at this conference it's quite important. So some background. So this is CoCos, it's a contingent convertible bonds in sovereign debt context. So what is it? It's a suspension of payments when the government faces some liquidity shocks. So sometimes it's common that they can go through some funding costs due to external factors that are not related to domestic issues. So during those times, the government's financing needs increases. You can think of it as natural disasters or some, like it can be GFC type of a shock or COVID type of a shock. So the trigger should be that it shouldn't be manipulable by the government. It should be tied to the government's repayment capacity. But there are some critics. The critic says that if the lenders anticipate such a scheme to be implemented, they might be more likely to lend, which may increase the probability of a crisis. So what do? So we provide a quantitative model with these assets. So what do? There are two assets now the government can borrow from. So one of them is in non-contingent debt. This is kind of loan that the governments have been borrowing all along. And now on top of it, we say that now the government can also borrow with corporate debt. So in the contract, it states that in such times that is suspended. So with no penalties on it. So it's a part of the contract. So what do? So after that, after writing the model, we use our model to investigate the effect of introducing such a policy. And then we propose additional modifications to this contract. For instance, we introduce haircuts. So if haircuts would be better, if the contract is written in such a way that the contract also introduces some haircuts, it can be that, for instance, the nature of the contract is even though your debt is suspended, your debt accrues interest on the suspended during the suspension. So what we're going to say is that what would have happened if the interest during the suspension period is forgiven or even reduced. Or we're going to also look at, rather than not paying anything, maybe governments can pay a fraction of their promises. So, and this is also relevant because we know that after COVID-19, after the success of moratoria, now banks, particularly in the UK and in Europe, started offering these payment holidays for mortgages. So what happens is that if you're going through some hardship on paying your mortgage, bank tells you that, okay, come, don't pay, you don't have to pay anything, maybe you can just pay the interest, but not the principal. And this is following the success of moratoria, the introduction of moratoria by the governments in Europe. So banks observe that, okay, this turns out to be a good policy. So they start introducing the payment holidays. So we also look at it in the sovereign context, maybe rather than not paying anything. So the government can also pay something. So this is also part of the package. So here is the preview of my main findings. So what do CoCos do? So when during hard times, your consumption still declines, but do not decline as much. So it reduces the decline in consumption. But there's a trade-off. So what happens is that now lenders know that you're less likely to default, you're less likely to evade default during bad times. Now your asset prices during bad times increase. Now this incentivizes the government to borrow more, right? Because now you're less likely to default, your asset prices for everything else being equal is not increasing. Now what the governments do, they start borrowing more. So on average, now the government ends up with a higher debt, and this increases the default frequency. even though the government does not default during bad shocks, but they start defaulting during long times. But eventually, overall, what we find is that introducing CoCos provides some substantial welfare gains, and this is mainly due to initial jump in consumption after the arrangement. And also, we also find that eliminating interest rate during suspension is also better. And in fact, we are going to have some, even debt forgiveness is going to provide stronger welfare results. So here model grids, I saw some faces and they are quite familiar with this type of models. So I can quickly go over the model outline. So our benchmark model is Wiedenbrüg theory paper 1981. And then there's some quantitative framework after that. So what we do is that we take this off-the-shelf model and we introduce liquidity shocks. So each period, the government observes this aggregate income shock and liquidity shock. So the government decides to default or not, and then the government borrows using a standard loan and contingent loan or a CoCos. So how does the payment schedule look like? So both bonds are perpetuities. So for a standard loan, what happens then if a government issues a unit of bond at time t, it promises to pay these coupons at a geometrically decreasing rate. So at time t plus 1, it pays kappa, and then it decays at a geometrically decreasing rate. So what does it look like with CoCos? So with CoCos, the government issues debt at time t, so the CoCos debt at time t. Say at time t plus 1, the government goes through some hardship, so a liquidity shock. The government doesn't pay anything at time t plus 1, but it starts paying at time t plus 2 with interest rate equity. So the black dots was like standard loan, what it used to happen. So with blue dots is what happens with the CoCos. So pay nothing at time t plus 1, shock is over, and then start paying at time t plus 2, and the interest rate accrued. And notice that the magnitude of the debt just shifts. So this is the payment schedule. So both are perpetuities. Okay. So what is the next? What is the liquidity shock? We tried a number of different alternatives of defining this external liquidity shock. The one that I'm going to present today is lenders become risk averse holding sovereign debt. So there are episodes of, you can think of it COVID-19 or in GFC. Lenders suddenly become risk averse holding the government debt. So these are the times in which that the contract is triggered. So we also model it such that those times, global risk premium times, overlap with lower domestic income. And the intuition is that CoCos can provide debt relief in times where borrower values that relief more. So how is default modeled? So this also studied in the literature. The government cannot commit on the debt contract. If the government defaults, it doesn't pay any current or future debt obligations in the past. So when the government is in default, cannot issue debt while excluded, and the government is also subject to an income cost while excluded. And then when the government comes back to the international markets, the government agrees with the lenders to repay some portion of the debt, whether through renegotiation or through some fixed amount. So how much? 5 minutes. 1 minute. Okay. So here is a simulation. So for our analysis, we use the data from Mexico. So nowadays Mexico becomes more of a common. It's I would say kind of like it's becoming standard to cultivate the economy into Mexico. So the first column is the data column of Mexico, and then in the baseline economy, we match our model without introducing CoCos. So we make our statistics to Mexico's aggregate moments, and the model does a good job on matching the data. And now what we do is now we introduce the CoCos. Now we say that, okay, now the government can borrow with two assets, with standard loan and with the CoCos loan, and how do things look like? And this is what we're getting. So being debt to GDP ratio in the long run increases. It goes up from 43% to 53% almost. And the share of cocoa debt in the government's portfolio becomes almost only 3%. Now the government borrows more on the cocoa debt rather than using the standard loan. The interest rate, the SIP rate on the standard loan almost remains the same in both economies, but the spread of the CoCos is slightly higher. And this is also the fact that lenders do not like lenders do not like their receivables to be suspended, so they would like to be compensated and they ask for a higher rate. But what happens is that defaults in 100 years. So maybe I'll present this one. So liquidity trigger default. So in 3% of the time, the government's default because of liquidity shocks. But with the CoCos, now the governments do not almost default at all with liquidity reasons because of the CoCos. You don't have to pay anything. But now, on average, now the government defaults more because they borrowed high, and because of this high borrowing, the government starts borrowing more. Okay, this is the transitions. So I'll just for due time constraints, I'll focus on a couple of charts only. So blue line is the benchmark economy, red line is the economy with CoCos, and the yellow line is the economy when we introduce debt forgiveness. So we can just only focus on for the time being for the blue line and the cocoa economy. So at the time of introduction, notice that the consumption of the economy with CoCos is higher than the baseline, but in the long run, it's lower. And the reason that it's lower is because defaults. So next pre-default probability is higher in the economy with CoCos. So over time, because of the higher defaults, the government ends up having a lower consumption. And this is the long-run dynamics of this CoCo model. So the baseline scenario is the one with purple lines, with dashed purple lines, and the solid orange lines or yellow lines are the ones with the CoCo economy. Notice that almost all the time, the economy of baseline economy, the economy without CoCos, had a high consumption during normal times. But during that times, now the CoCo economy has a high consumption. So what happens is that the government shifts its portfolio, shifts its consumption from bad times to good times to bad times, so it arranges its consumption so that it has a lower consumption volatility. So average consumption during liquidity shock period episodes declines 1.3%, but without it, it declines around 4.3%. So how can we improve this design? So this is as I said, we are going to try two different policy analysis. One of them is that let's assume that the governments can pay fraction during suspensions, or they don't pay anything. So 0 is the case where the government doesn't pay anything during suspension episodes, and it appears that it has the highest welfare gain. So the government basically the optimal outcome of the strategy is not to pay anything during the suspension. How about suspension rate? So this is my last chart. So it shows that there is an optimal haircut rate in which that around this place, and that forgiveness is optimal. And it's also we show that it's also reduces the default rate. So if a contract needs to be written, it can at least be written that interest rate and suspension do not accumulate any interest rate. So just to give you context, for instance, Belgium did something similar for that moratorium for mortgages during COVID-19, and they enforced banks not to accrue any interest rate during suspensions. So it can be done. I think I'm done. Yeah.
So the last paper is a collaboration of the team and the African Development Bank. It's presented by Alexandre. Kopoin. Yes. Go ahead.
Yeah, good morning. My name is Alexandre Kopoin. So I'm from African Development Bank Research Department. So this is a paper of some of my colleagues at the Bank Research Department. So here, what we are trying to look at is the drivers of African debt finance. So it is a paper that's going to the African economic outlook that we work on also. And yeah, just for the plan of talk, it's 5 steps. So first of all, I'll give you the context why we're doing, this kind of study. And the second point, we're going to provide a short literature review that is based on the paper that we are doing. And then we'll see, how we'll unpack the drivers of public debt. And then I'll provide some of the results here, and then provide some conclusion. So in terms of the context, I just want to show you two, key charts here. So the first one is, the public debt for African countries, before the HIPC initiative, and the second one is the debt service on external debt. So, the key point here, if we look at the first chart, we can see that there are 3 main episodes. So the first episode is before the HIPC initiative. We can see that, that the ratio here was increasing. And, if you look at that store, it's not a stock, or also if you look at public debt, you also can see that it was increasing. And just after the HIPC initiative, we can see that debt is starting to decrease, from the lower points here around just before the global financial crisis. And then after that, we can see that debt started also increasing in many of African countries. And if we also look at, the debt service, we can see that if you compare the average debt service, between 2015 and 2019, just before the COVID pandemic, and we look at also the debt service just after the COVID pandemic, you can see that, there is also, an increase in the debt service on external debt for most of African countries. So those are the key elements that I want to show on the chart here. And it's here just to give you 4 African countries that, more recently they faced debt distress. And I just mentioned here, 4 countries: Angola, Zambia, Nigeria, and Mozambique. And the key point here is that, we saw that, since the global financial crisis, you can see that debt vulnerability, increased in African countries. And here you can see 4 main African countries where we have debt distress, more recently. And that is starting that's one of the motivation for people. So as debt is one of the key elements, one of the key concerns for African countries. And now we can see that debt vulnerability is also increasing in many African countries. So as African Development Bank, which is also one of the institutions that provide debt to the countries, we want to know what are the elements, the drivers of public debt accumulation, and just to provide some sense of the increase on debt. We can see that just between 2013 and just before the COVID pandemic, you can see that debt moved from 30% GDP to 61% GDP. And when you look at, just after the COVID pandemic, just, between 1 year, you can see that debt also increased by 10 percentage points in average, in average for African countries. So the goal of this paper here is just to see what are the key drivers underlying the accumulation of debt for African countries. And as I mentioned, the key question is that to try to determine what are the key factors underlying the debt accumulation. And here, what we do in the paper here, it's Unpacking paper. It's very close to the paper that we go presenting, but here I'm just like I'm opening a bit of black box of what it shows to us. So I'm not going to spend time here. And in terms of literature here, there are many papers, that try to, understand what are the key drivers underlying the public debt accumulation. And one of the key paper that I just want to sit here is, APIA 2022. They found that public investment, consumption, and corruption are the key drivers of the debt accumulation in the African countries. And we are also in another paper in East Asia. We also found the same, more or less the same, underlying factors that explain the accumulation of debt in Asia, East Asia countries. And when you go to advanced economies, we can also see that here there's a paper also want to show that interest rate and GDP growth and inflation are also some the key element that explain the debt accumulation. And there are other papers also trying to, disaggregate what are the, the factors of external debt and also the factor for domestic debt. But all those papers here, trying to see that there are some common key factors that explain debt accumulation. But there's no, there's no, or say, so a paper that you use like a large sample of African countries, and that's what we are doing here. So we also trying to have a robustness check also on what we are doing. So it's like a complement of what we already know, but in terms of African perspective, that's what we are doing. So how do we do that? It's very simple. So we just go through the paper that I already mentioned here. So we have some of the fractional factors that explain the accumulation. And as I mentioned, we have an exchange rate, and I think you also mentioned that. And we have primary deficit, real GDP growth, interest rates, all those factors, from the paper that we saw, most of them are not from African perspective, but they all explain, the accumulation of capital. And we also, in the African context, some papers also explain that, infrastructure financing is one of the key elements that explain also debt accumulation in most of African countries. And a component that is also important is the interest rate growth differential, which is also a key element of debt accumulation. So basically, what we do, we take most of a traditional driver here in the African context, and then we add some of the additional potential drivers that we know from other papers also. And we have also the external shocks, fiscal policy, expansionary, political and civil instability. So all those elements, we are using them to see if they are working, if they can explain the accumulation of debt that we saw, for most of African countries. And the approach is very simple. It is an error correction model. And here the different variable is the debt GDP ratio, the ratio that we for African countries. So it is a panel regression. And the control variable that we use, all of those are from, as I mentioned here, the fractional factors and also other additional potential factors. And the main specification here is very simple. I have a debt to GDP ratio here, which is explained by the lag of debt to GDP ratio, interest rate, GDP, and other control factors. Or we put them into X here. And the control factors are here, as I mentioned. We have a primary balance, inflation, inflation rate, trade openness, and population growth. All those factors that we put them here, we see what are the contribution, in terms of explaining the accumulation of debt. And here, I'm not going to spend too time here on that, but just to show you that most of the data that we use here, they are from, the World Bank, World Economic Outlook. We also have the World Development Indicators and the African Development Statistics Development. And here it's a few descriptive statistics of the main component that we use for, in our framework. So those are the previous issue. But what I think is very important, I want to spend time here is in terms of the result and what we get. And as I said, it is like we're opening the blackboard that is explaining what we go already presented. So in terms of empirical strategy, it is very simple. So what we do, as I mentioned, we have the error correction model, and then we estimate that using the OLS estimator. That is our baseline estimation. And because we also know that there might have like endogeneity issue, all those things. So we also try to use the German method. Okay, the German method. And so we try the German indifference, the German system. That's to make sure that the result that we get from the the OLS the estimation are robust on it. And so that is our empirical strategy. And in terms of the result here, here is the short-term, result that we get. And as I mentioned, those are like explaining what people mentioned. So we can see that interest rate is one of the key elements that explaining debt accumulation. We have a real GDP growth. We have also prime balance, and another element also is exchange rate, depreciation, and we have sort of inflation. So here we have a fixed effect result and also a effective result here. So the difference in terms of column here is somewhat variable that we think might not have like a much important effect on the debt accumulation. So we are not here in the first column, first two columns that are secret. So those are the any question?
No clarification question or just very just clarification. Yeah. Okay.
Thank you.
But just it's really something unclear.
Yeah. Clarification. The clarification refers to this jump in the accumulated debt and the debt servicing. Is it also because many of the African countries have graduated from lower income countries to lower middle income countries, according to the World Bank, and the terms of interest and the terms of loans are becoming even more stringent? So is it one of the reasons why we see the difference?
I would say we don't have evidence on that. So, it might be risky to say yes or no, but,
it is a good point.
Yeah.
My hunch is that my country's own experience, that Bangladesh, when it graduated from LIC to LMIC, the interest rates and the terms, that the grace period and the maturity period have gone up.
Okay, yeah, let's continue with that. We'll come back to that. So, and very quickly. So here it's I'm just presenting the long run effects of estimation that we get, and those are like very close to what we already know and what we just presented. And here, just want to present you the magnitude of the effect. So what we do here, it's very simple because we have the long run coefficient. So what we do, we just take the coefficient that we multiply by the standard deviation of the factors divide the standard deviation of the dependent variable. So it is a kind of standard deviation to see the magnitude of each component. And here you can see that when a country has like elevated external debt in the previous period, it has like more chance to have to accumulate, to have higher to accumulate more debt in the future, and that is also a key element also. So for in the debt resolution, all those things that are going on now, we know that external debt also play a big component in terms of debt accumulation. And then we have also certain fiscal surplus. So when a country run the fiscal surplus, it's also help as we go present it helps to reduce debt accumulation. Higher GDP growth also help also. And then we have higher interest rate, which is also a big component of debt accumulation. And the less of control of corruption. As we know in some of African countries, yes, to have that component that also work, and we have ethnic depreciation that we're currently seeing. That is another big component of debt accumulation in African countries. And then what I do here in the next step, I try to do the same thing using the German method, and we get more or less the same result. And the main component that I mentioned, which you have real GDP growth, primary balance, interest rates, they are all main components that explain debt accumulation in African countries. And I try to plot the same thing that we see in terms of the magnitude, have the same. Some of the components have less magnitude compared to the baseline, but basically we have the same component that explain debt accumulation. And lastly, just in terms of takeaways, two quick points. So the traditional factors, as I mentioned, primarily is exchange rate movement, inflation are the key element that explain the accumulation in African countries. So, and also, yeah, political stability. It is like, it is not, let's say, it's a political issue, but we know that political stability also impacts the accumulation. And the governance also, effectiveness also is an important element of African countries. So our finding here, as I said, it is a paper that's going to the African Economic Outlook, which is a mid, analytical and mid policy document. So it is not like a sophisticated economic work, but just to, put forward what are the main components that main policy drivers that the policymakers can use if they want to reduce the accumulation in African countries. So that's what I want to present, and we can continue further. Thank you.
What I will do now, so we have almost half an hour of questions. I will ask the presenters to take their chairs and turn them around so you can face the audience. And then if you want to participate, you can also pull your hair closer. So meanwhile, you have time to think about your questions. I'm not going to ask a question. I'm going to leave the audience with lots of expertise and I know people who talk about those issues. I will just ensure that there's balance, that everybody gets one question or two. So maybe, yeah, Mark, and then and that's all I see for now. So let's start. Mark.
Okay. So first, really great presentations, very enlightening. I have questions for Yasin and Alexandre. So Yasin, if you say that debt service payments haven't been halted in times of difficulty, then what was DSSI, the Debt Service Suspension Initiative? So that's one question. And then just to clarify, so CoCos, they've never been used for in a sovereign debt context, just in mortgage markets.
Mortgage and corporate market.
Oh, all right. So maybe you respond and then.
So maybe it's suppose and then.
Okay, I have one question for Hugo and not for Yasin. Hugo, this vintage Hugo work. I mean, you look at the data and you find some interesting things. But I have one problem with the way you blame stock flow adjustments at the end. I think if you are going to look at the exchange rate, you put it in your original equation, when you have inflation and interest rates, if you are looking at debt to a large proportion in foreign currency, it should appear there. Because now, I mean, the stock flow adjustment was interesting, but then you say it's exchange rate. So I think it's an interesting angle to disentangle the two. For Yasin, I mean, I'm going to read the paper very carefully. I've done some work on this in the context of their sustainability. But one question is the suspension is endogenous in the model, or you just fix the suspension fee? And the other thing, which I think is very important for your model, the pricing of the CoCos is not going to be the pricing like regular bonds. So any conclusion you find when you compare the two will depend on the spread. But I like it.
So we'll Corsat go first, your friend will go, and then invite you to think of questions to the other two.
I have a couple of questions.
Okay, sorry.
That's okay. So, Alexandra, when you listed the independent variables, you put political instability, but then I didn't see it in the version. Like, I couldn't match what variable was linked to political instability. I think it's, in my opinion, you mentioned it, but I think it's a plausible, explanation variable. And then my second question is, your results show that high population growth reduced debts. I'm wondering what's the intuition behind that, because I would think that it will be the opposite. So, that's my question.
Maybe you go first.
So it is exactly the SSI, with one important difference. The SSI was after like everything has happened and then people were gathering together, how can we help these countries? What we are doing is that now it's going to be the contract. So now lenders are going to choose what to borrow. So lenders can borrow like standard loans from the government, they can borrow these CoCos contracts. And they would know that in such times, the suspension rate payments are going to be suspended. And in the SSI, everyone has to agree that they have to suspend the investor. So that's the crucial difference. And your question, liquidity, it's exogenous, like meaning that there are some very similar laws saying that natural disaster laws. So when a natural disaster case, lenders agree to suspend payments. So that has been issued in a very small scale, but it's been done. So during those times, the suspension is triggered, so you don't pay anything, and then you keep paying. What the model does, the pricing of the asset is entirely endogenous. I know it's like as endogenous as sustainable. So standard loans like it's entirely endogenous. It depends on the default risk and the liquidity risk. Also, in this case too, it's entirely endogenous. It depends on default risk and the exogenous like income costs. I think that I answered all the questions.
So you're right, Stavros, but in theory, I could decompose that into local currency debt and external currency debt. And then I could even attach which debt is in euros and which one is in dollars and which one is in rand and which one is in whatever. And then decompose everything and then would absorb a lot of the stock or reconciliation. I said in theory, because if you want to use a technical term, data on that composition suck. I simply cannot do it for many countries, and for sure I cannot do it going back on time. So as I mentioned, so the next fiscal monitor doing work exactly on this. Yeah, much more resources than Hugo. And so they are doing exactly this. For me, for the data I could access, I basically did the opposite. In a sense, I made the kind of the assumption that I can get no information whatsoever on that composition, which is an extreme assumption. I can get some information. It's not very good. I compute the stock flow reconciliation, and then I regress the stock flow reconciliation on changes in the interest rate, and I kind of back up what the currency composition effect. But you're right, it's the ideal world. If I had retail data on that composition, I could plug in all the balance sheet of the country and attach exchange rate, and then we suck up a lot of the stock flow reconciliation. But the main message still be the same, that a lot of your debt explosion is driven by movement in exchange rate. But of course, it would be a more precise measure, but you need this information. It's very, very hard to get, especially if you go back in time, in recent time.
Yes, thank you for your question. I think for just question, for stability, I think you're right. So, the government indicated that we use in the regulation, we use two components. We use governance effectiveness and also political stability in the regulation. But here, including, in the showing the research, because of states, I removed one message. That's why I already presented government effectiveness at the UX. But those are the two components that we found that significant in the regulation. So, for example, I will go with it. I will present critical stability with the government effectiveness in the and on the population, I think that is the key, the very key points. And the answer is that because what we are looking at is debt to GDP, ratio. So when population is also increasing, also that will have impact on GDP. So the ratio will, tend to decline. But if we were only looking at the nominal term of debt, for sure, I'm very good, 100% GDP, that's when population is increasing, that will increase the set. Here we are looking at the debt to GDP ratio, and there are two components of, as I said, the impact of population on GDP, and also the GDP growth. That's also impacts on the accumulation. So the effect is not straightforward, as I mentioned, but here we found that it's positive. It's something probably, and we need to pay more attention on that. That is financial.
So I have 4 questions or more. Okay. So I am give the priority to someone who wants to ask a question to the paper on safe harbors. There. Okay, so Frederick first, and then I have an order.
Thank you very much for the paper. Really interesting. It's a great framework to analyze the existing bills and laws. But thinking more policy, what jurisdictions do you think would need to consider this legislative reform? Because obviously for bondholders, it's relatively straightforward. There are 2 laws dominating the market. But for the other creditors, may not, obviously there is no necessarily law dominating. Which jurisdictions are you thinking to?
I will take your questions first, or shall we go?
Take this one and then we go so that makes it a big round and then
Okay, so I think the answer is ideally as many countries as possible, but it matters more which countries, in the sense that it is the countries that are integrated into the trade and financial flows, and where the assets of the debtor are located. If you capture, if 95% of all their assets, creditors are in one jurisdiction, you don't need that. Obviously, the broader the base, the better.
So I have in the order I have Marin, Uchadis, and here, and then we're gonna draw.
Okay, thanks, Martin. Thanks a lot for the presentation. Just a quick comments on the way. I would like to know your thought about the way we consider the debt crisis as an issue which can be directly related to the increase in debt. My point is that most of the paper looking at the drivers of the debt, maybe less in the one because you were focusing on the stream of the debt distribution, but with the SDGs and the financial requirement, of course, we expect those countries to get more and more indebted. So is just looking at the level of debts something that can be proceed as looking at the problem of debt sustainability, or should we more focus on debt and sustainability metrics, such as, for instance, the categorization of the DSA? Because, for instance, if you look at the data prior to the COVID, you have 2 countries, Kenya and Mauritania. Okay, they are different, but in terms of debt level to GDP, they are pretty much the same. But one was considered as high in risk of high debt distress, and the other one in moderate or low risk of debt distress. So is just looking at the evolution of debt to GDP ratio enough to see the drivers of over-indebtedness, because this is what we are interested in? Or is it better to look at other metrics that better capture the sustainability or not of this debt to GDP ratio?
So, and I forgot, please introduce yourself before asking questions.
Yes, thank you. My name is Mustafa Rahman. I'm from Center for Policy Dialogue, a think tank in Bangladesh. My question, just in the form of a suggestion, because what we are seeing in some of the developing countries is that they have taken a lot of loans from China, Russia, India at the LIBOR SOFR flexible rate. Now, these were during the COVID time less than 1%. As we speak to today, it is 5 to 6%. So, is there a suggestion that you can make with regard to not taking this type of loans, during negotiating loans with our bilateral partner, particularly bilateral partners? The second is with regard to the structure of the debt. Now, some of the debts they generate income in local currencies. And their inflation and exchange rate becomes a problem. But some of the debts, particularly by the corporate sector, they go for export-oriented industries. So their exchange rate should not be a problem as long as they can service that. The third point is that the debt carrying capacity, the World Bank IMF framework of the debt carrying capacity, if you have any critical, because we have seen that debt GDP percentage doesn't speak much. Bangladesh debt is 24% of GDP, but we are under tremendous debt stress now. So if you have any comment with regard to the IMF as World Bank framework of debt sustainability. Thank you.
Thank you very much. The third one, and then we have answers, and then we go to another.
Yep, during the
You introduce yourself, sorry. Now I
yes, yes, this became an American veteran. During the legislation presentation, the claim was made that there is no evidence that trust in legal systems is being undermined. We've really only had one restructuring completed with documents available since the start of these legislative initiatives. Suriname, in Suriname's docs, there is language about venue change by creditors. Sri Lanka, maybe the next restructuring will be completed. It's a matter of public record that creditors are working on venue change legislations at their sole choice. So is it really true that there's no evidence of jurisdiction change being considered?
Great. So, sorry, the questions were addressed to Marin, and
Yes, I think, yes.
yeah, but more.
Should I go first?
No, maybe. Okay.
Yeah, I think those two questions are, very close, and I think you're right, here we only look at the debt ratio. I know it is a one way to see, to look at debt vulnerability. That's why, the IMF framework, I'm not going to comment that, they use more than the debt ratio. They also look at debt, debt service to expand all those things. They also bring some expert judgment to what they are doing. So you may have two countries with the same debt ratio, but they don't face the same debt vulnerability. That's what you mentioned. So here, I know it is a very limited using debt ratio, but so far it's the only, I would say, major, benchmark that we have. But we can also use another variable, as I mentioned, the debt service would also be another component. Debt service, and use that as here we focus on debt ratio. And I agree that, it's not a full picture of debt vulnerability for the particular for African countries, because as I mentioned, there are other components like political, situation, control of corruption in the country. So there are many things going together. Just that I can take example of my country, I'm from Cote d'Ivoire. If you look at the GDP ratio Cote d'Ivoire, you can see that we almost 56% of GDP. The country is doing very well. There is no, if you go to the country, you can see that the country is growing and everything is doing well, but the GDP ratio is higher than the 20% Bangladesh. But they don't face, the country is high, has a high GDP ratio, but it's doing well. And other country like Bangladesh, 20% GDP, as you mentioned, they face vulnerabilities. So there are other components, as I mentioned, other components that we need to pick in the component analyzer. And probably just to finish, what might be the best? So after the assessment that we do is when it comes to policy recommendation, we need to make it country specific. So, we list most of the important components of the debt accumulation. But when we go to country specific, we need to know what's the macroeconomic situation of the country. And we make an assessment. That's what our IMF is doing for the assessment that's there for the whole country. Stop it.
Would you take one on variable rate, but yes, levels?
Okay. So maybe just quickly to this, I mean, that what Alexandre said, that is observation is one piece of information, but there are many other things that matter. It just maybe to link it to the question of the IMF PSA, one should focus on what the key source of vulnerability. So the IMF framework now has this problem that artificially splits country into groups, low-income country and middle-income country, and uses different metrics for these two group of countries. One focuses on total public debt, the other one focuses on external debt. I make no sense to it. Under certain conditions, this doesn't make any sense. So it should be adjusted. Well, on the variable rate, there is the usual issue of, what is cheaper ex ante and what is cheaper ex post. Right? That's an infinite discussion. So I don't have much to say on this. What I just want to comment is I want to make on what you said is about the corporate sector borrowing dollars. So here, I was just focusing on public debt. I assume Alexandre as well was just focused on public debt, so it's not corporate debt here. When we did talk about corporate debt, it might be different. But interesting enough, at 5 p.m. this afternoon, I have to drop DebtCon to go to the 5th floor for a PhD defense here at PSC of somebody writing about corporate debt in Colombia. And the funny thing that the thing that's like, is Colombian firms don't use this natural hedge. So basically what this student was defending his PhD is finding that there is almost no correlation between how much firm exports, which is what creates natural hedge, and their level of foreign currency debt. So you're right that in theory there is this thing, but at least in the case of Colombia, which I read the paper, they don't seem to be the reason.
Anahí or the team?
I'll just make a few points and I think I will make a few more. Hopefully what I was trying to say, what Anahí said, is that the design choices for the restructuring laws that you implement matter a lot. I think if we think about Suriname, the Suriname sovereign debt restructuring probably could have used a little bit more transparency in the sense that the different creditors, it was a very small held group of creditors with not a lot of public discussion. And I think we have a few more cases. Actually, if you look at all the countries that were covered by the UK law under the HIPSI initiative, I think only one claimant tried to bring a case, and it was a claim that wasn't covered under the statute. So I think our point is more that obviously, if you make bad law, it can influence the trust in the financial system. But hopefully, what we're trying to give an overview here is that there is options to do this that sort of chimes with the philosophy of inter-creditor equity and a good sovereign debt restructuring process.
Just to complement that answer very quickly, our claim also was not that the argument has not been made by relevant parties and by creditors in particular, that it might undermine the trust in the jurisdiction and in the financial center. In fact, we've seen similar arguments being made in other contexts. So for instance, before collective action clauses were introduced, a similar argument was made that it would heavily affect the pricing of the bonds that included collective action clauses. And the evidence suggests that although the claim was made a priori before the clauses were actually introduced, ex facto, this was not the case. And we do not know necessarily what would happen if particular laws are adopted in different jurisdictions. But we do think that it is relevant to also understand that the a priori commentary of different legislative proposals, but also the legislative proposals in general, might not necessarily be the kind of fact of the matter afterwards. Because clearly that's also, just to put it very boldly, kind of strategy, right? So we think that it's not necessarily a good indication of what might happen.
We have minutes. Are there any lightning quick question? I have one here, one over there, and I think that's it. Really okay.
Thank you. I guess I work at the Paris Club Secretariat. And I have a question on the paper on the CoCos. It's more of a policy question. how would you compare this kind of instrument with CRDCs,
With what?
climate resilient debt
Oh.
clauses? Because it's identical, except that the trigger in the case is the climate shock, and you're looking at the biggest shock, right?
Yeah.
So, do you think that those CoCos could be widely used in the case of sovereign bonds? Would it be efficient to have this kind of instruments? First question, and second question, which goes with it, what would be the incentive for investors to accept such instruments? Because as you said, they're risk adverse, there's a higher risk for them with introducing this kind of instruments. So what would be the incentive for them to work with this kind of instrument?
So yeah, I think that's two great. So really quickly, one question.
Yes, quick question for I'm the members. For Hugo, you showed us for the increase in debt, the exposure was driven by exchange rates, but for the payment of debt, a big factor was also inflation, and potentially this could be driven by monetization of the debt. So I was wondering if you make the link between those big main factors. I have one question, but yeah,
Go ahead.
Yes, thank you. My name is Godfrey, something from the University of Ghent. So my question goes to you. I was wondering why we are still focusing so much on debt to GDP ratio. You know, it's a bit backward. There are more forward-looking measures. But almost most of the African countries that are going through debt crisis. So the IMF, World Bank applied their debt surveillance framework. Debt to GDP ratio didn't tell us much. So I was thinking probably for robustness test. You can look at other indicators so that we begin to tell a story that looks more both from liquidity dimension, solvency dimension, and then also our problem is more hidden debt also, right? So if we focus more on debt to GDP ratio, we are able to have off balance sheet debt that usually do not go through the central debt accounting metrics. And then we get onto the problems between the managers.
Thank you. Glad you want to start.
Yeah. So like, I think we learned quite well. So it's very similar to natural as it goes, as it goes. So but our question is the moment, right? So what would have happened if governments would have issued CoCos? And what we're finding is that we find, okay, there are valid gains, so governments should do it. Now it's a more valid question, like one that I asked. Now why are they issuing it? What's the problem, right? So now what we are doing is that they should issue, and now the next step is that what's going to happen for them to issue. Said valid post question, it can be discussed even further, but I don't know good answer to it. But for instance, what I've learned from after the COVID, so for instance, banks never did this moratorium type of law, right? So once you defaulted, banks never issued this moratorium law, but the government stepped in and they said that now you have to issue moratorium for households who wants it. And now banks learned that this is actually good. So it turns out that the households, the mortgage holders who receive the moratorium eventually pay more than the ones who don't receive it. So now banks, without the government intervention, now they do themselves with these payment holidays. So there might be something that triggers for sovereigns to or for lenders to accept this type of loan, so that it's better for everyone. But I don't know what would that be at this time. But we are just providing to the public that ex ante, at least these also are not really good.
Quickly, so if you have fixed rate, long-term, nominal domestic currency debt, inflation wipes it out, right? So for external debt, it depends on whether PPP holds or not. PPP holds, the effect on that is exactly zero because the currency depreciation would be identical to the differential in inflation. Since PPP doesn't hold, I don't know, it depends. Usually that goes up because exchange rate reacts more than the inflation.
Yes, so yeah, I think we already explained, why the PPP ratio is not okay. Yes, for your question, yeah, please. Yeah, I think we already explained why the PPP ratio is not it should not be the only component to look at. And I would take it like an example of a doctor. When you are sick, you go to see the doctor. The first thing that you will check is your temperature. And when your temperature is higher, it means that you are sick. But you may have different sort of like a disease. But here it's the same thing. When your temperature is higher, you may have that issue. But that's why you can go to the IMF, you go to the African Bank. There's a component we call matrix that we use that. But beside that, we use other components. And if we go to the DSA of IMF, there are many things that they are combining to get people to decide whether the country is a moderate level of distress or high risk of debt distress. And as the African government, we do the same thing. When the policymakers go to a country and they want to make a lending decision, they're not going to look at the debt ratio only. It's not that the only benchmark. There are many components surrounding the debt ratio, but at least it is one of the key components, as I mentioned for the doctor, to see if you are sick or not. Thank you.
On this really therefore, thank you very much to the speakers. It's a great first session. The typical of DebtCon, I had like the two economic paper, the one descriptive, one regression, one model. It's really economic paper and another paper. So thanks a lot to all and have a good lunch downstairs.